Well, we've just seen the Nasdaq close up for a 9th straight day, something we haven't seen since December 2020. Momentum favours the brave, they say, but it's pretty clear to me that the market is saying if we're going to chase anything into year end, it's going to be the Magnificent Seven and this mega caps tech situation playing through. We have a look at the crude trade, where we're seeing the price down 20% since those September highs as the $100 calls seems to be slipping away from the market at the moment. We go into FX markets where the dollar's finding a little bit of form, and we preview next week's CPI print, which of course the bond bulls are going to be looking at very closely indeed. It's time to get in front of the screens. This is the trade-off. Well, hi there, I'm Chris Weston from Pepperstone. I'm going to be joined in 2 seconds by Blake Moreau from Forex Analytics. And we're going to be going through the setups that are front of mind at the moment, the key themes that are rocking these financial markets. Mr. Blake Moreau, I'm going to bring you straight in. What I was talking about with my wife, and I bored the absolute bejesus out of her a couple of days ago, was this idea that we're now 1 year away from the US election, something which I'm sure is going to be absolutely deafening around the world, but specifically for you guys out in the US. Really interesting. Obviously, I'm trying to become an expert in how this all goes down, the different timelines and the different risks that could be coming through, that are playing through at the moment. How excited are you about getting this situation? When did the markets start thinking about this becomes a bit more of a volatility event?
Good question. Well, considering we just got past a lot of regional elections last night, I think soon. I think when you start seeing these debates, the primary debates now, interesting thing is as President Trump is not going to be debating. So I don't know how this is all going to work, Chris. All I know is he's being indicted for a bunch of charges, and Biden doesn't know where Monday is, and I don't know, Chris. I can tell you this much: I'm not super excited about it. As I was explaining to you, I spent 4 years trying to manage my own book and other people's money because I was trading for a fund at that point. And through Trump tweets, and I have a feeling I'm going to be dealing with Trump tweets again, and it's tough because you can't really relax when things are happening like that because he moves the markets.
He does. He's
talking about either a good thing or a bad thing.
He's talking about putting a 10% tariff on imports, which I think brings in this protectionism, brings in trade wars back again. I think personally, a year's a long time for markets and politics. I think you've got to wait for the national, the Republican and Democrat conventions, which come through in July and August before this becomes a market event. Until that such time, we're watching the primaries. But I thought I'd just bring it up because we are on that countdown to one of the big debates for next year indeed. But let's go towards things that are more close. Thank you. Sorry, mate. I just had to do it. I know. But we'll be talking more about it. Anyway, I think let's bring some of the things that are more close to home. So let's have a look at some of the topics on Topical Thunder. Nasdaq 100. What I'm seeing at the moment, Blake, is this chase. Is it a chase? It feels like it's a bit of a chase going on. The Magnificent Seven, your Apples, your Amazons, your Nvidia, those stocks which did so well for such a long portion of the time, and there was a bit of heat came out into earnings season. But now they've started to find their mojo again, and we've just seen the Nasdaq up for 9 consecutive days in a row, as I say, with something we haven't seen since December 2020. I know a lot of retail traders will be sitting there going, something up 9 days in a row, we've got to go and short that. But I did a cheeky back test on the performance of the Nasdaq. Every time we see 9 days in a row, which I think is about 17 different occurrences that we've seen since 2010. If you actually look at the performance of the market 20 days later after that point, we're up about 70% at the time, with an average gain of about 2.7%. So, momentum is clearly favouring the brave. I wouldn't be shorting just because we've seen that sort of run of form. But the market's saying to me, Blake, that if we're going to chase anything into year end, we want to do what's worked. And we want momentum, and we want these high cash flowing businesses. So I think if you're going to chase anything, that's what the market is showing you right now, and pullbacks are buying opportunities. How are you seeing it?
Well, first of all, I think the NASDAQ 100 is in a breakout. We broke the channel resistance technically. This is indicative, or I'm sorry, I should say it it's late in the day for me, so you guys always have to excuse me for saying. Sometimes I say some weird words that don't really make sense. But the rally that we've seen in the Nasdaq is characteristic of what you would see in a bear market rally. It's very, very, very fast, quick, short squeeze, and and it makes sense right now. And I say that because we have a big risk event that I want to say we got over. The market is mentally getting over the what's happening in Israel. We could argue and we could debate whether it's going to be a bigger deal in the months ahead, but for right now, the market's kind of brushed that off. Like we talked about last week, it's kind of refocusing on what earnings and everything else. So you got people that are positioned poorly. You got a lot of people de-risked, in the market. They're caught not owning enough going into seasonally, as you've been pointing out the last couple of weeks, a very seasonal, strong time to be in the markets.
Nasdaq's up 11 months of November in a row, right? For whatever reason.
You're right. And you pointed that out last week. So I know the natural tendency for traders is to fade and to stand in front of it and say, 9 days in a row. I mean, what's the odds of it being up 10 or 11 or 12? But look, it's been a pretty powerful move, and short squeezes in bear markets, which I think this is, even though it looks better in the Nasdaq than it does in the S&P or other indices, it's still squeezable and it could last. And you have to think about what's favoring the market right now. If yields continue to come down, that's going to take a lot of pressure off of the market. So
Great point.
I don't know, Chris.
How do you feel though? I mean, when you're adapting your strategy, I mean, if you can trade mean reversion, momentum, trend, whatever you're doing. But right now, with me, with the Nasdaq, I'm saying buy what's strong, sell what's weak, keep it simple. It's working, right?
I think that's the way to navigate it, Chris. So, but let's continue this conversation about the markets, and let's move into the next topic. And I actually wanted to bring this up because this is, after such a big rally, this week feels like, to me, like, especially in currencies, the market's kind of catching its breath and just kind of, just getting reallocated. But I believe this next week is going to be a very big week in the market. We've got US CPI coming up. We got China, industrial production, retail sales. We got UK CPI. I got it all written down over here. Aussie employment. And we actually have the US government, potentially another US government shutdown, which I think the market's going to be kind of numb to it. I think everybody understands we're going to get through it. We might not see the jobs report on time, but it's not like it's critically, unless it goes on for an extended period of time, then the market will become a little bit concerned. But the date of I believe it's the 17th, if I'm not mistaken. Yeah, we may shut down. Big deal. But I think that the data points that we're seeing going into next week are going to be kind of big. But this week's a bit of a snoozer. And I think as long as nothing jumps out of it, I don't think any of that we're getting a lot of Fed speak. I don't want to say just Fed, but we're getting a lot of central bankers speaking. They're not saying anything that's really jumping out. And as long as that doesn't happen, I think volatility stays low. The market grinds higher. How are you seeing the market right now this week going into next week?
Yeah, I think it's interesting. The shutdown could be interesting from a point that we don't get, if it goes on for a while, we're not going to get the payrolls number. And I think that's really interesting now, the payrolls number, given what we saw in last month. If we saw a 4 handle on the unemployment rate, the recession heads would be, that's the SARM recession indicator coming through because it's raised 50 basis points off the lows. But yeah, I mean, there's a natural handbrake. We talked about it a while back. There's a natural handbrake on how long the shutdown goes on for, because if active servicemen and women in the US are not paid, that's very politically unacceptable. But to have missed 2 payments, there's going to be absolute outrage from the public. So you've got a natural handbrake on how long it goes on for. So I'm not expecting that to be a volatility event. In fact, I think the markets are probably saying we're going to get to that cliff edge and there'll probably be a deal at some stage. And given everything that's going on with aid to Israel and Gaza and also in Ukraine, one suspects that they're going to get a deal done pretty quickly. I think the Chinese data is going to be interesting there. The CPI number is the big one there. But what's important is if you look at rates pricing now, the market's pretty numb to what they're seeing. We've got nothing being priced in for the December meeting. There's very little being priced in there. We've got 4 basis points of hikes being priced in for the January meeting. So rate hikes are not on the table any means at all. You'd need to see a massive CPI print to see that coming back on. And in fact, the market's got in this strong belief that next year we're going to see some juicy rate cuts coming from the ECB. 80 basis points of cuts being priced in, 68 basis points of cuts from the Kiwis, and also from the Canadian central bank there. In the US, we've got about nearly 3 rate cuts being priced in for next year. So that's the interesting thing is that I think you're going to need to see something pretty punchy from the data flow to bring hikes back on the table in the market's eyes. In fact, we're looking ahead to next year and we're saying there's going to be some chunky cuts. So,
if I could mention this before we move on really quick, I want to tip my hat to my colleague Ryan Littlestone over at the UK Trade Off.
Big up, Ryan.
Also Michael Brown as well. They had a great conversation on the rates conversation and rate cuts. If you haven't seen that episode, go back and see it. It was filmed a couple of days ago. It's a really great episode. Good job. Well done, gents. Can't even get it out late in the day. Okay. So.
Yeah, it's good, mate. Listen, I just want to go on that the bond situation, because I think, the pressure valve has been taken off the market. The long end of the curve, I mean, certainly 30 years have seen really, really strong buying, as you'd imagine. If you're a bond trader, that's going to happen because of the convexity that you get from long-term bonds. But 10 years, the one that gets probably the lion's share of the attention. And we saw that trading from above 5% down to where we are at the moment, 450. And also real rates, so if you adjust it for expected inflation, have come off. And maybe that's part of the reason why people are going back into tech in a big way, and that's been the outperformance. But it has given some life. Last week we had the best week in the S&P all year, and the Nasdaq was up over 6%, something you don't see in a regular basis. But I think part of that's down to the fact that we saw that Treasury refunding where the TBAC came out and said, skew your issuance towards the front end of the curve and less sort of duration sensitive areas of the market and term premium sensitive market. And I think that's been really, really very powerful force for the bond market. But next week we've got CPI. As I say, we're expecting the market's expecting headline inflation to come down to 3.3%, core to stay at 4.1%. Again, that's something that the market is looking at. So how much lower can yields go, and what does that mean for the likes of the dollar and the Nasdaq, Blake?
Well, first of all, let's just talk a little bit about this bond market move. And I just want to say, technically, we have finally broken out of a channel that is contained the 10-year note, literally since, I have to go back and look, since April, May, right? So for the last 6 months, we've been following this channel. If the 10-year note trades a 109 handle on the actual notes, we could see a little squeeze higher towards the 200 DMA. That means that we would have further falling in yields, and the dollar will probably be under pressure, which it's going to lend some support to the Nasdaq and the stock market and risk in general. And so it's interesting because there's so much supply coming, and we all know there is. But this little tweak that the Treasury did last week of issuing more bills and less, bonds and notes. You think about the FOMO, the FOMO trade, and people go, oh crap, what longer term yields are going to start to go down. They're going to start to go down again. I'd better capture them right now at these levels while I can. And you're getting that FOMO move where bonds could actually squeeze a little higher here, and not because we're not going to get more supply, not because anything else other than traders want to capture that yield while they can, and you might see a little bit more chasing, which ironically is going to support equities. And one other thing I wanted to mention, Chris, and we could go on and on and on about this, but I have to mention that bonds rally when they're rallying for this reason. It's not a bad thing. When you see bonds rally on risk aversion, that's when you have to start going, okay, how's it going to affect gold? How's it going to affect stocks? How's it going to affect the dollar? But right now, gold is moving on, more supply and demand. And
well, I think I'll take a counter argument to that. I think you're right. I think 70% of the move is. But look, last week we saw payrolls coming in at 150. That's a clear slowdown in terms of the 4-week moving averages come down, or 3-month moving averages come down to 204. The average hourly earnings is coming down. We saw a poor consumer confidence number last week. ISM manufacturing and services were okay, but weak. Well, the services number was okay, but was weaker. So I think the data has cooled. It's certainly not collapsed. But I think your point is a very valid one, and that is that if bonds were really rallying because people were pricing in a greater chance of recession, which they're not, I don't think, then that would be bad for the equity market. But you're right on the supply side of things. That's the case. Yeah. So I think it's we've got to remember there's a lot of algorithmic tracing and sort of non-humanic people chasing this market as well. So big one there, but we'll see.
And I know we need to move along. And one of my colleagues mentioned there's a lot of money on the sideline that's looking to park it in some of these longer term notes and bonds too, which makes a lot of sense. I mean, if you think about what it's yielding and you're like, do I take on the risk of equities at this point? Anyway, long conversation. We could go way more than 3 minutes, but we got to move along. And I got to say, well done, Westy. You talked about the Aussie last week and you called it. You said, I know what other people are saying, but Michelle Bullock, she's going to raise rates. And, I know there's 63% chance of the RBA raising rates. And they did. And you said the Aussie's going to 90 cents and it went straight down. I'm just kidding. You didn't say that. But the Aussie did go down, which a lot of traders are like, wow, they raised rates, but it was more of a one and done, or basically the RBA's going to do what the Fed's doing, raise rates. We're going to keep rates unchanged for a while, and the Aussie sank. But it put Aussie traders in a really interesting predicament, I think, because if you look at the Aussie pairs are stuck between a rock and a hard place. Do we rally because China is looking a little bit better and all the stimulus and, the Aussie economy is doing okay. Is it? But then, how about if we get and risk is going higher? However, how about if risk breaks down and do we sell Aussie dollars and do we get short? And maybe the RBA is done raising rates. Where does this leave the Aussie dollar in your view, being a boots on the ground, hardcore Aussie RBA caller like you are, Chris?
Yeah, I mean, I think that when the Aussie fell on the rate hike, a lot of retail traders were sitting there going, what on earth is happening? This is not supposed to happen. But yeah, I mean, it was just the fact that it was in the price to an extent. I think the leveraged hedge fund community had amassed quite a decent long position in the Aussie as well because of those reasons. Technically it broken out and of that wedge. And I think people were expecting a little bit higher into 66 cents. Obviously not the case. And the actual guidance in that last paragraph was tweaked just enough nuance there for people to say that is a dovish hike effectively. And I think that's where, given that we're pricing in 1.5 rate hikes, that's where that's why the Aussie fell. But yeah, I think if you're trading against the US dollar, which of course most people do, then you're just tracing a risk proxy. So if the S&P was to go down, the Aussie's going to come down. And I think there's, if we were to see Chinese equity markets, go a little bit lower, then I think it's just going to find that correlation. Look at copper, have a look at base metals. I think Aussie's found the strongest correlation right now with industrial metals. I think that's where it's taking its cues. Correlations come and go, Blake. You know that. You've been trading a long time, and you've just got to think what's making it sensitive. Right now, I think the strongest correlation with the Australian dollar is those industrial metals as opposed to the S&P futures, for example. So that's what I'm looking at as a driver of the Aussie.
Okay, so I mean, as an Aussie, and I get it with the Aussie against the dollar, but how about Aussie against other currencies? I mean, are you you've been constructive on the Aussie for the last couple months, or I would say last 4-6 weeks. Are you still constructive on the Aussie from a bullish side?
There's an interesting one, right? Because if we go into the 1 and 2 year forward rates and see what's being priced in, I just put out a tweet on this, on what's being priced in, and there's really only 2 countries which are seeing aggressive rate hikes, or not so aggressive, but like rate hikes over the next 12 months, and that's Australia and Japan. Everywhere else is expecting big cuts. Now, that in one way would say that's quite supportive of the Australian dollar. But in the other hand, we're saying, well, if everyone else is cutting, maybe the Australian will probably ease off at some stage. They're not saying that at the moment. I don't see any reason why they'd be doing that. but maybe there's some downside risk to that. But yeah, if you want to play a pure interest rate cycle, you're doing it against the New Zealand dollar, and that's come under a little bit of pressure over the last week or so. So yeah, you just got to just know how to,
some, right?
You just got to know how to trade the Aussie in terms of like using it as a vehicle to express a view. If you want to trade a risk-on thematic, you do it against the US dollar, the yen to an extent. If you want like risk-on, risk-off thematics, you play it against the interest rates, you play it against the Kiwi. And if you want to play a lower VIX, for example, then you can do it against the euro. That can be an interesting one as well. But there are things that make me constructive on the Australian dollar. But I think at the moment I'm taking more of a cautious approach in the short term here, given how it's trading.
Well, it sure has been hard to short, and up until the RBA met, it was really holding up pretty well. So well done,
exactly.
Chris.
Anyway, let's go into that's the setup and see some of the charts on mind. Yeah, I want to bring up crude to start with because it has been. Catching a falling knife. I mean, it's broken level after level. We got through that 200-day yesterday, broke out the sort of the August swing low that we'd been seeing. Number of reasons here. Obviously, that Middle East premium has come out of the market. People were saying that it could be some supply disruptions. There was a premium priced in, notably around Saudi. I think that people are saying that, obviously, terrible humanitarian story we're seeing unfold every day, but this is not going to affect crude supplies. That's been priced out. The International Energy Agency, the EIA, have come out with new forecasts, and that's been impacting as well. And we're coming up to a point where we're going to see a review of the Saudi and Russian oil output cuts as well, and so people are looking at that as well as the technicals. If you actually have a look at the curve, the first 8 month has now come back so sufficiently. We may even get an inverted or a contango curve as well, and all those factors have seen sellers in the oil market coming through. Now, Blake, I'm not sure if you've looked at the fundamentals, but I know you look at the technicals. Are you a seller of rallies in crude here?
It's hard. This is a hard one. And I mean, it's dropped further than I thought it'd drop, and now where it's at, I think it could go even further. I think it, and I'm not. I'm going to just say this. I'll just blurt it out really quick. I don't think what we've seen in the Middle East is quite over just yet, and I think it's still going to. It has the risk of intensifying a little bit and still dragging other nations in to this Israeli conflict war, but. As a result, I still think that if it dips down towards 70, I might actually get my knife catching gloves out myself. I don't trade crude that often, but 70 and a half, right around there, is a 78% fib retracement. And if you look back, I mean, based on your chart, you look back over the course of 2023, the lows of 2023, it's dips below 70, it gets bought. Isn't that where President Biden is buying crude too?
I think so. I mean, refill the
SPRs,
right? I think the other issue. I mean, what would have come up on your radar in the last week though is the Canadian dollar and the Noki. The Norwegian crown's been absolutely battered from pillar to post, and people have just been using that as an expression. Obviously Brent prices are falling with WTI, and terms of trade matter there. So that they've been like the whipping boys of G10 FX, haven't they? So I'm sure Euro Noki's come up closely on your radar. Swiss Noki, all these dollar Noki as well have come up there. So they've been the sort of momentum plays the last week or so.
Yeah, I remember like the setup from last week is the US dollar Norwegian krona. I happen to have krona exposure right now as we speak. Yeah, so I ask me when I get out, see how well I did. But I have some exposure. Let's just put it that way. So I'm gonna take you. I think this is I know we didn't really talk about it, but we dip towards 70. I might stick my toe out, see if the water's warm. All right, let's move into the Euro Aussie. This is my setup, and this is why Chris, I really wanted to have this Aussie conversation with you. The Euro Aussie is in the apex, if you will, of its triangle, and it's getting close to breaking out. Look at how it's oscillating on both sides of the 50 DMA. The breakout points are pretty easy. 164.40 or 164.50 to the downside. That's the breakdown point. The breakout point is 168, 168.50. It's 400 pips in the Euro Aussie. I hope most traders understand this, especially if you're new, you should understand this. This tends to be might have an ATR of 180 pips. To move 400 pips in this pair is not hard to do. Anyway, breakout is looming. I think if you're trading risk on, risk on, meaning you think stocks are going to go up, we're going to see a Santa Claus rally, you're looking to the short side. So maybe you're looking to sell into this resistance. The flip side is if you think that there's some risk aversion coming in, look at what's happened the last couple of days. That could just accentuate and see an upside breakout above 168.50. Chris, how are you seeing the Euro Aussie right now?
I mean, I don't think either currency is liked in the market. So you're playing two currencies which don't really have a huge amount going for it in the short term. So I favour playing that range at the moment, fading it into the top end. Just tactically, I think that makes sense. You can look at positioning, and I think the market's probably more short euros as well. So that favours an upside break in from a positioning perspective. But I think this trades the range, and I'll be looking to sell into strength and looking to buy the weakness in that, and obviously just trading that. But I think if you were to see a breakout, then that could be very powerful indeed. But yeah, I don't like either currency particularly that much at the moment. I think the market's saying the same thing, and I think therefore you trade a range. Would you concur in that situation? You think that those two horizontal levels are going to hold?
I do. I mean, I'm kind of torn on which way I think the markets are going to go from here going into year end. So I think that the market, as you pointed out, is apex is tightening. And so as it tightens, you play that range, but you play inside of it and you try to get out before a breakout. So this way you can capture as much of the range as possible as we contract. So
there's a reason why it's contracting, because, people are seeing the fundamentals and saying, well, there's a bit of a battle going on, but no one's really prepared to make a stance, and that's because people are agreeing that they're both currencies that are not particularly outshining one another. I mean, obviously currency is a relative play, so that's what we got to look at. Anyway, I want to show one that is looking a bit more attractive at the moment from a pure price perspective, and that is the crypto scene. Obviously, Bitcoin is the leader or the poster child in that one. And we saw, obviously, a nice run-up through October in price. Obviously, everyone getting very excited about this SEC announcement of a spot ETF. We had a bit of a pause, as you'd imagine, into 35,000. And, it looks like we want to break to the top side there as well for another leg up. I mean, this is one where, the trend followers sit in and go, we've got the breakout. We don't know how far this is going to go. We know that there is really no better than a vehicle for FOMO than crypto. It feels like this is going up, and it will just continue to go up. We're already seeing that in some of the altcoins. They're having some crazy moves. What do you think, Blake? Would you be touching this one?
Absolutely. Above 36,400, and the next target is 42,000. And let me explain why. Long term, from the all-time high of Bitcoin to the low that we saw, I have to let me see if I can get the number for you. The low that we saw, which happened to be November of 2022, the 38% retracement is the 36,300 level. All right, depending on how well you're drawing and what feed you're using. The 161% extension of that last dip that you see from basically almost half of your screen to the current price. We are at the 161% extension. It's at 36,200 or 300. So a break above 36,500, you're talking, I'm sorry, it's 127% extension. Excuse me. A move above 36,300. So I look for it to clear maybe 500. Your target would be 42,000, which is the 161% extension golden fib of this entire move, which comes in around 50% of the entire drop. So basically what I'm trying to say is I'm bullish. It looks bullish, and it looks like it's going to break out.
I don't think you can look at it and say that anything else other than it is bullish, to be honest. I mean, obviously people are there is a chance that we could get an SEC verdict. I think there's 12 different issuers who are looking for the spot or the cash spot ETF coming through. It could happen in a matter of days. I know that I think the deadline, the max deadline is January. But there's a small window at the moment where we could get the one through, and I think the market is saying we don't want to be caught behind that. But I mean, you don't need to be necessarily a technician to look at that chart and say, where are the odds skewed? And of course, that's all we work with as technicians is the probability and the distribution of odds. I mean, I don't see how you can look at it any other way and say that the odds are skewed to a bullish chart really in that situation.
I had a good friend of mine today that I talked to about the markets. He also mentioned that there was, and I have to read the article, there was like 700,000 new crypto applications in one day. Like, it's like, I have to go back and read it, so don't quote me on that, but it's, I haven't read it yet, but I was like, wow, that's a lot of people betting on crypto right now.
You can do things like just go and have a look at like Google searches and type in Bitcoin or crypto, and that will tell you when it's starting to get hot. A bit of anecdotes around that I think is good. But when everyone starts piling in, because we go back to our friend expected returns, right? There, a lot of people through COVID changed the way that they thought about expected returns. Meme stocks could give you 200% in a week, and people don't want 5-10% in a month. They want 200%. So if this starts roaring up and kicking in, we've seen that in the altcoins, Sol and a couple of number nines. People just chase it because they want the big returns, and crypto obviously offers that in spades there.
It's bigger than sports books, guys. I'm telling you, bigger than a parlay. All right, sorry, I digress. Let's move along to our last setup, which would be. This is a viewer question from Danny Boy. He basically was asking about Santa. Hello, Danny Boy. He's asking about Santa Claus rally and the HK50, which didn't look as good as the Nikkei 225. He asked about maybe a Santa Claus rally in either one. I'm just going to say this: that's a bull flag pattern. We held the breakout point, which was big, and remember Warren Buffett's and his army of investors are behind the Nikkei right now. And given the fact that we could not break down this summer in September, when we tried to dip below that 31,000, basically, just leaves us open for a rally to the 161% extension, which is 34,610. And then all of the investors from 1985 in the Nikkei 225 will be made whole by then. At that point. Right. I'm sorry if you're invested in the Nikkei and since 1980s and that's happened to you. But what I'm saying is it still looks bullish here. And I think if a Santa Claus rally does unfold, a rally above the 33,000 level would target 34,600 in my calculations. What do you think about the Nikkei 225 going into a Santa Claus rally? Because you believe in Santa, Chris. At least your kids do. So let's keep it that way.
That's right, mate. Look, I mean, one thing we need to remember with the Nikkei and topics and all these markets is they are priced in the yen. So if you are going to to get that move up, then you really want the carry trade to come on quite well, and that's going to keep the yen weakening, and that's where you're going to get the breakout. So you're almost taking a view on the yen. I know we don't talk necessarily about exporters and importers and the impact there, but you've got a market that is priced in yen. So if the yen's weakening up, you always want to buy something, in theory, an asset which in a currency which is perceived to be the weakest currency, and you're going to get double bubble. So the fact that we've got, if you think the yen's going to continue weakening off from that, dollar yen's, depends where you live. Aussie yen moves higher. If you live in Australia, dollar yen moves nicely above 151 for you. Then the Nikkei is going to do well. But there's a lot going right in Japan at the moment in terms of they've got easy monetary policy, which is obviously good for the equity market. You've got a central bank that's keeping JGBs fairly well contained. Not great for the banks, but for most of the other parts of the market. You got wages which are increasing quite sharply. Economics, tourism's back in Japan in a massive way, pre-COVID levels there. So, I mean, fundamentally, like the market, you just need a weaker yen. I think that's what pushes up there. Anyway, I think if you get the technical break, all those factors that I just talked about get aggregated in the price, and you'll be able to see it for yourself. So don't make it too hard on yourself. Wait for the break and trade the break. I think most the thing. Anyway, let's go to play of the day. Let's see what's front of mind. I'm going to jazz it up. Long Nasdaq, short Russell 2000. I do. Look, I think one of the things is that the Nasdaq is up 9 days in a row, and it's hot. It's a super hot market at the moment. And yeah, it might take a breather. You might say some people taking profits from that situation. At some stage, probability suggests that's going to happen. But I think that this ratio is working well, really, really well. For whatever reason, I think people will chase. If they are going to chase, they're going to chase NASDAQ. They're going to chase those mega cap stocks, that magnificent seven. Obviously, that's going to impact the NASDAQ. The banks at the moment, the KRE, the regional banks are trading fairly poorly. I don't like the price action I'm seeing in the regional banks. And if you look at US 2000, it's much more inward in the US. It's much more facing. It derives a lot more of its earnings from the US economy, which is okay. But I think we're going to see a much slower Q4. And the banks, it's a very heavy weighted market towards the banks, whereas obviously the NASDAQ isn't. So fundamentally, I like it. Technically, obviously you can see that ratio is trending down, and it doesn't really move up too much. So you've got a natural stop loss in the trade there. So I think this continues to gravitate lower, and I think the NASDAQ into year end continues to outperform. So I think this is so I like looking at short positions in the S&P, tying it off with the notional exposure the same by being long the NASDAQ.
It's interesting, Chris. I think you've used this chart or this setup as a setup or play of the day multiple times over the last couple months.
I would have just done better just holding it. I've been trading it.
No, it works well. The trend's there. I think it still looks great. And you can make the case for it still. I'll
tell you a cheeky thing, which I'm not supposed to say because I work at a broker. But if you go short the S&P US 2000 and you go long, you effectively net off the swaps, or you reduce your swaps. So if you're holding those positions for a longer period, because you're going to get paid on the short position, you're going to get charged on the long position. So effectively, if you want to hold those positions for a long period of time, it's a low beta strategy, but you're also reducing your overnight funding costs as well.
Ooh, that's good. Then you can go more long Bitcoin. Did I just spit that one out? That one just jumped out of me. I don't know where it came from. All right, let's move on to my play of the day. And that's going to be the Euro Yen. And the Euro Yen, I'm mining, for golden fibs. Now, if you know me pretty well, you know that I love the golden ratio of the 161% extension. Universally, when we get there, I'm always looking the other direction. Doesn't mean I'll take advantage of it, but I look for it. And the Euro Yen, no exception. We're about ready to rally into channel resistance. You can see the very divergent RSI. Now, you could argue, Blake, if we continue to rally and we continue to push higher in price, that RSI is going to go higher and overbought. Yes, but it'll still be divergent. Unless we go up like literally 2,000 pips from here, we're probably going to stay divergent on the daily RSI. So I just drew that red line there for illustration purposes. Anyway, if the Euro Yen gets to 163.50, 163.66 is the RSI, the 161% extension, I am looking to dip my toe in counter trend because I do believe in the Japanese economy. I do believe in, in the fact that the BOJ is going to start to normalize its policy sooner. And I do believe that the Eurozone is going to struggle in the months ahead. So I think the Euro Yen is primed for a reversal if we see it. And I'm going to just look to be like maybe a quarter of my normal size to look to short as we reach those levels. I'm not short the Euro Yen, but I am actively looking to stick my toe in and stand in front of this train, as they say. So there it is.
There it is, mate. Well done. Good stuff. Anyway, thank you everyone for joining us this week on the trade-off. If you want to leave any comments down below, we'd like to hear what you're saying, and we'll try and reply them where we can. Give us a like if you can. We appreciate that. And obviously, we'll see you back next week for more of the trade-off.